Hi, my name is Sagar, Kalra, Head of Gold Research at Mackenzie, and just here to discuss my views on gold and just talk about some of the hidden risks that the industry is facing that nobody's really focusing on. So just to start off this conversation, I think we all need to understand what's happening with the prices because that's the hot topic right now. And when I look at the prices and what's keeping them where they are right now, I see three major factors and the three U's that I talk about. One is the uncertainty that's mostly driven from the US tariffs and whatever is happening in the US internally as well. They have their own internal problems, but then at the same time, if you look at what happened when the tariffs were announced, so just the graph on the left shows you that when Donald Trump won the election, gold actually fell and everything else went up. The dollar, the S&P, NASDAQ, mostly because he's considered pro-business and there was a lot of optimism. But then what happened during the time when he announced the Liberation Day tariffs, everything fell at that point. Gold is an asset, so it's going to also be affected by the movements. But then gold went really high. I mean, it's climbed, around 60% in 2025. Other things also obviously recovered, but not as much as gold did. So there is a lot of uncertainty that's coming from the side of the US. Second thing is the unsustainability, which is, the levels of the US debt. And when they announced that they have passed the big, beautiful bill, which is again going to lead to more debt. If you look at the debt to GDP ratio, that has gone up by around 3.5% year over year, and it's sitting at a whopping 125%. To that, you add the fact that there are questions around is the Federal Reserve independent anymore or not? Because when the administration will put some pressure on the Federal Reserve to reduce interest rates. So the whole trust that the investment community has in the dollar as a reserve currency gets shaken. And I think that's what we're seeing right now. So we're seeing massive inflows of ETF, very strong central bank buying, because the idea is that countries are trying to move away from the US dollar and move more into hard assets like gold. Final point is, China being obviously the second biggest economy right now. It's trying to exert its influence on the global stage, and it's trying to create a parallel system where countries can bypass the dollar and perhaps trade in its currency and kind of convert it to gold. And they're trying to tackle it from various angles. So, for example, they allowed their top 10 insurance companies to invest 1% of their assets under management in gold. So that is not speculative demand, that's institutional demand, and they're planning to do it over 3 years. So that's strong institutional demand that they're trying to put in place. Then they have such a huge appetite for acquiring gold mines. Obviously, what they have in their own country is not very visible. They don't disclose a whole lot, but they are the largest producers and consumers of gold. So these three factors we feel are what's really driving the prices. So what does this mean for the miners? So when we look at the cash flows, so if you look at the graph on the left, so you can see that 2024 was perhaps the highest, from 2005, and 25 obviously is supposed to, surpass that. So obviously miners are making huge amount of money. Literally every miner is making money at this point, irrespective of their cost base. So on the graph on the right, what we try to do is we try to do a bit of a scenario analysis, and we raise the cost, say 15% across our data. And what we realize that even at inflated costs, the numbers for, say, at a $28.50 an ounce cash flow, it's still higher than what it is for 2024. And then obviously we are nowhere near 2850. We're in the 4,000 range right now. So you can see that there is no problem with where the companies are sitting right now. Of course, gold price doesn't have to go higher for companies to make money. Of course, they would want that to keep happening, but they're pretty much in a very good shape right now. And I think by now people start wondering that wasn't my presentation more about risks, and nothing that I've said so far sounds very risky. And the reason I wanted to say all this before is to kind of tell you why these risks are getting thrown under the rug. Like what's happening and why is it that, like there's so much glitter, like pun intended, for gold right now, that all the various issues are getting hidden. And I'll go into those now. So first is the costs are rising across the board. It doesn't matter if you're a major producer or a mid-tier producer. Cost rise is something that is impacting everyone, and they continuously have been growing. Of course, there's a huge amount of cost consciousness now, but still, costs are something which are very much troubling the industry, and it's not a rear view mirror thing. And there are multiple reasons for that. You know, you have aging ore bodies, you have higher royalties, taxes. Well, labor is a big challenge for mines based in, say, Canada, US, and Australia. Labor challenges, labor costs are much higher. Contract rates are refreshed more frequently. So that is one challenge which I think, again, because when you're making so much money because the prices are so high, any kind of cost base is good enough. Second, I think, is the depleting mine life. So over the past few years, we've seen that there has been less investment being put into the industry to replenish the reserve base, to replenish the mine life. And that has been a problem. I mean, reserve exploration expenditures were curtailed when the prices fell in 2013. And after that, the exploration spending has been less. So we see a continuous decline in mine life. And Australia is a very good example, I feel, when you look at how these two factors so far have influenced so much of M&A that we have seen in gold. So when you look at, say, mergers and acquisitions like Kalra and West Gold, Silver Lake and Red 5, in all those cases, there were companies that was, towards the fourth quadrant of the cost curve and having a lower mine life, having no mine life beyond 4-5 years. So kind of companies thought that, okay, let's just kind of pool our resources. A lot of regional consolidation we have seen in Australia to kind of cut duplicate costs. So all these factors are leading into more M&A, and perhaps one of the reasons why we see so much activity in the sector. Next would be exploration spending again, which is obviously on the left. We'll just track the exploration spending of some of the major gold companies. And you can see that there is a healthy trend that it has been going up since the past few years. Even for 25, it's pretty strong. I mean, the bar shows a different story, and that's because Newmont acquired Newcrest, so we have one less company over there. But what's interesting to know is that a lot of the exploration spending is on brownfields. And again, the theory is, again, that brownfield is easier. You have the infrastructure set up already. You just need to mine another deposit, get the cash flow, and market obviously rewards you for that. So if you look at, say, a company like Newmont, they do say that 75% of their exploration spending is going towards brownfield. Now, in theory, this is not a bad idea because obviously at this point where the prices are, this is the time when you can get, I mean, the way I see it, it's like even your dirt is profitable right now because the prices are where they are. But this can be overdone. And an example of that would be Goldfields. So Goldfields, back in 2022, they tried to acquire Yamana. And the key rationale was that they were running out of projects. They didn't have growth potential. And obviously, the acquisition didn't go through. It was a high premium that the market did not like. The CEO had to quit his job. And Yamana got another competing offer, was better for them, and they went somewhere else. The point I'm trying to make is that, and before that, if you look at Goldfields, they did not have a greenfield exploration program. Their investors were very happy with brownfield, just keep on returning cash to us. Why are we trying to go into more adventurous things? But the idea is that when you will run out of growth, you will have to do something to get that growth, and that's where high-priced M&A come in. And after that, they did have to go for different kinds of M&A, and they again paid up, like 43% they paid for Osisko Mining to get an entry into Canada, and then 55% they paid for Gruyère's 50%. And this was also a revised offer. The initial one was rejected by the board of Gold Road. So I think it's just you have to be a bit careful, because I think the industry is still struggling from some missteps of the past, but you can create new missteps currently if you don't invest in your future growth. Next, I think projects, again, the same story. There are projects coming online, definitely, but what we see is that whatever is now coming online, so at Wood Mackenzie, we classify projects as base case, probable, possible, base case being the most likely to come online, and followed by probable and possible. So if you can see that the capital intensity of the base case project and the capital cost is much lower than what was built into the past. So whatever is easy to build, whatever is something that The payback periods are shorter, is what's going ahead. And what's harder to do is either put on the back burner or is perhaps sold off. An example would be Eldorado Gold. They had a mine in Brazil. They sat on it for 10 years. And there was nothing wrong with that mine. It was actually a low capex mine, but their IRRs, what they wanted were different, and they wanted more return. So they sold it to someone else. They acquired a 20% stake in that company. That company, G Mining Ventures, they brought it online, and that mine is now producing. So there are a whole host of reasons why companies may not build. I mean, if you look at some of the majors, they've been doing a lot of M&A, doing a lot of divestment, because there is a whole zeal to just focus on tier 1 assets in tier 1 jurisdictions. So just get rid of everything that you think is not that profitable. I mean, it is profitable, but not that profitable. So your internal rate of returns that you want could be higher. So that will again push project development at the back. Then the declining ore grades, which is, I think, a feature not only of gold, but of every commodity out there, most of the cases, like even copper. So what does that mean? So if the grades are declining, then you will have to mine more material, which will again raise your cost, which we already talked about, that costs are increasing. And that will also lead to higher emissions. So on the graph on the right, so I understand that at this point in time, the whole narrative on being green or consciousness on emissions is kind of lost. But I think when that returns in time, it will be beneficial for gold companies to kind of showcase that their footprint is greener than other mining companies, mostly because gold does not add any value to the energy transition story. So if you're a copper producer, people need copper for electrification, nobody needs gold. So I think it helps them attract money if they're saying that we don't have a footprint or not as bad a footprint as some of the other companies, and definitely benefits their costs. And the last point is that the ESG environment is becoming all the more challenging, and we've seen that in a lot of countries. This is again going to kind of impact the cost, which already is. The table on the left shows you various African countries that have been increasing royalty rates, increasing their taxes, and everyone is trying to refresh that and get a bit of a bigger slice for themselves, which makes things harder. On the right, again, this is not something limited to African nations. Even in Australia, we had the issue with Regis Resources, McPhillamys project, that had to be kind of canned, at least for the time being, because of environmental challenges and community resistance. Similar thing with Loma Larga in Ecuador. And if you look at some of the mines which have been taken over by the government, say, especially the case in point would be, say, Mali, what happened with Barrick. I would say, convert these numbers with the gold price and see that it runs into the billions of dollars. So there's a lot of money involved if governments come in and try and do this sort of a thing. So there are all these risks which I think are interlinked to some degree to each other. They do talk to each other. But I think where we are right now, it's, everything is just shining bright. So I think that's where I wanted to just end my message, that it's a good time to be a gold miner, but I think the miners would be better served if they do focus on what they want to do in future with the amount of cash that they're generating, because keeping the shareholder happy is something that no amount of it will be enough. So you have to also think about how you are placing yourself for the future. Thank you.